Ever feel like your financial life is playing hide and seek? You think you've got your budget sorted? Then bam, an unexpected expense pops out of nowhere. Today on The Deep Dive, we're shining a light on some of those financial surprises, big and small. We're diving into the latest consumer news, cutting through the clutter to bring you the insights that truly.
That's right. We're your navigators in the often choppy waters of consumer finance. Our focus today is on the trends and headlines highlighted by the news aggregator podcast May 21st, 2025, Consumers.App. Think of it as the Cliff Notes to what's currently shaping how we spend, save, and, well, borrow.
And Consumers.App really gives us a broad view, doesn't it? They cover everything from the nitty-gritty of credit scores to the expanding world of private credit and how to manage your money wisely as you approach or enjoy retirement. It's a fascinating snapshot, really, and we're here to extract the key takeaways for you. Okay, let's get started with something that touches almost all of us, credit scores. Consumers.App featured a headline from Fortune India. Poor credit score. Here's how quickly you can rebuild it and what you need to do. What struck you as most important in their take on this?
Well, what's particularly noteworthy, according to the analysis from Consumers.App, is the swift impact our credit card habits can have on our scores, They emphasize that a sudden dip often boils down to a few credit card-related issues. Missing payments, obviously. High utilization using too much of your available credit, generally over 30% is kind of a red flag. Or opening numerous new accounts quickly, or even closing older established accounts.
Right, closing old accounts can hurt.
Yeah, it can reduce your average account age. And it's eye-opening to realize that just one missed payment, it can potentially cause your score to plummet, maybe by over 100 points. That really underscores the need for, vigilance with those due dates.
Ouch. Yeah, that's a tough lesson to learn the hard way.
Yeah.
So if you do find yourself in that situation, what kind of timeline are we looking at for recovery? Weeks, months?
Years. The information from Consumers.App offers some hope, but rebuilding isn't an overnight fix. It typically takes several months, maybe even a few years for a full recovery. However, they also point out that you can often see tangible improvement within, say, 6 to 12 months. That's if you're taking consistent positive actions, like always paying on time, bringing down that credit utilization.
Yeah. Okay, so paying down the balances.
Exactly. Keep in mind, negative marks can stay on your report for up to 7 years, but their impact does gradually lessen over time as you show you're handling credit well.
Consistent positive action. Okay, that sounds manageable.
Yeah.
Now, what strategies does Consumers.App's analysis highlight to help people steer clear of credit card debt or, get out of it and safeguard their scores?
Consumers.App stresses several crucial areas. At the foundation is financial education. Just truly understanding how credit works is step one. Then, creating and sticking to a budget, using credit cards responsibly, not like free money, right? And seeking guidance from professional financial counselors if you feel overwhelmed. That's all vital.
Makes sense.
And interestingly, they also note that broader efforts like policy reforms and public awareness campaigns can empower individuals. And the data backs this up. Studies show that people with a stronger grasp of financial concepts, they tend to manage credit better and recover faster from setbacks.
So it's not just knowing the rules, but actually playing the game wisely, it seems. Now, shifting focus slightly but staying with credit, Consumers.App also touched on technology, referencing research into machine learning. How is AI changing how credit risk is assessed and, how cards are approved?
Yeah, this is where things get really interesting, according to the insights from Consumers.App. They point to recent research showing advanced machine learning and deep learning techniques are significantly boosting accuracy for credit card approval predictions. By using tools like neural networks, combining different models, even handling limited data, these methods are proving more effective than the old ways.
So what does that mean for us, for the average person?
Well, it could mean lenders get a more nuanced understanding of risk, potentially leading to fairer decisions. This could be particularly good for individuals working to repair their credit, as maybe these systems recognize positive changes sooner.
Okay. So it sounds like a potential win-win, better risk assessment for lenders, maybe more opportunities for borrowers. Now let's zoom out. What's the bigger economic picture? What impact does all this credit card use and debt have on us individually and on the economy?
Right. If we connect this to the larger context like Consumers.App does, widespread credit card use definitely fuels consumer spending. It's a major engine for e-commerce, which of course benefits financial institutions. But the other side is that high levels of credit card debt can seriously impact individual financial well-being. It affects people's ability to save, even their health sometimes. And on a broader scale, too much debt can contribute to financial instability. So it's powerful, but with downsides. Responsible use is key.
Definitely something to keep in mind. Okay, let's pivot. Another headline from Consumers.App, this one via Reuters. Private credit's boom faces a cyclical test. This sounds different from regular credit cards. What's the main difference we should grasp?
Exactly. Consumers.App helps clarify this by outlining the basics. Credit cards, like we said, involve borrowing. Debit cards, that's your own money from your bank account. Charge cards are sort of a hybrid you spend, but you usually have to pay the full balance each month. And these differences really shape how we manage money, our spending habits, access to credit, and, well, the risk of debt. Credit cards allow that revolving debt.
Got it. So debit and charge cards tie spending more closely to actual funds. Now, Reuters mentioned a cyclical test for private credit. How does the growth there and economic shifts affect risk for credit card companies?
It raises a critical point about how interconnected everything is. According to Consumers.App's analysis, the increasing exposure of private credit markets to industries may be facing slower growth, or those vulnerable to economic policy changes. Yeah, that has increased risk for both issuers and investors in private credit. What's interesting is the whole credit market acts as an indicator of potential financial vulnerabilities. So credit card companies also need to watch these broader trends and, tighten up their own risk management.
It really is all connected, isn't it? Wow. Okay, staying with credit cards for just a moment longer. Consumers.App also looked at our payment behavior, specifically that tendency to just pay the minimum due. What did they find there?
Well, recent academic research highlighted by Consumers.App suggests many consumers, even those not necessarily struggling, tend to default to paying just the minimum. It seems linked to a psychological thing called anchoring, where that minimum payment figure on the statement acts like a mental benchmark.
Anchoring, like that number sticks in your head.
Exactly. But research also shows if you can de-anchor people, like by clearly showing the long-term benefits of paying in full, the interest saved, they're actually more likely to pay more and cut down their debt faster.
Fascinating. A little nudge can make a big difference. Now, we mentioned technology for risk assessment. How else is innovation changing credit cards?
Consumers.App points to some really vital innovations in fraud detection and payment security. Huge area. We're seeing more AI and machine learning, including neural networks, techniques like SMOD.
Yeah.
They're getting much better at spotting fraud, even subtle patterns. And on the security side, you've got EMV chips, tokenization where your real card number isn't used for the transaction, and even biometrics like fingerprint or facial recognition, all making it harder for the bad guys.
All very welcome advancements for keeping our money safe. Okay, let's shift now from credit cards to maybe a less familiar area, private credit. Consumers.App highlighted a Bloomberg article. Private credit funds target billions in retail demand from Asia. What exactly are private credit funds, and why are they looking at individual investors in Asia now?
Right. So private credit funds, as Consumers.App explains, are basically investment vehicles. They provide loans directly to businesses, sort of bypassing traditional banks. What's new and interesting in Asia is they're now aiming to attract retail investors, everyday folks like you, as a new source of capital. This shift is happening partly because of digital platforms making it easier, and also some regulatory changes opening things up. It used to be just for big institutions, so it's kind of democratizing investment in a way.
Interesting. So what's driving this in Asia, and what are the potential upsides and downsides for the economy there?
Well, Consumers.App highlights India's retail evolution as an example. The shift from small shops to bigger stores, supermarkets, partly fueled by foreign investment rules changing. Now, the economic advantages of private credit targeting retail investors in Asia, things like diversifying funding sources, pulling in more capital, maybe boosting market liquidity, but there are risks, big ones, like ensuring these retail investors really understand the complexities. It's not like a savings account. Preventing mis-selling is crucial, and navigating the regulations to protect investors.
Yeah, those are critical points, making sure people aren't getting into something they don't understand.
Yeah.
How are digital tools helping this expansion?
Digital tech is really the engine here, according to Consumers.App. Mobile investment platforms, big data analytics, AI, they make it easier for retail investors to access these products. They streamline the process, lower the barriers to entry, improve transparency, hopefully. And they let fund managers assess credit risks better, maybe tailor products. It's fostering innovation.
Sounds like a big shift. But with all this digital tech and big data and Asian finance, what about privacy concerns? Data protection.
That's a very important point. Consumers.App addresses. As fintech and big data use grows, so do concerns about privacy and security, especially for vulnerable individuals. Key challenges are ensuring informed consent for data use, having robust security measures, and finding that balance. The balance between encouraging innovation and safeguarding consumer rights. Regulators and companies need to be proactive.
Absolutely crucial. Okay, let's shift gears again. Let's talk about retirement finances. This becomes relevant for so many of us eventually. Consumers.App highlighted a CBS News piece on MSN.com. Retirees and HELOCs. What to know now? First off, what's a HELOC, and what should retirees know about them right now?
Okay. HELOC, Home Equity Line of Credit. It lets homeowners borrow using their home equity as collateral. According to Consumers.App, the main things hitting HELOC rates in 2025 are central bank policy, inflation, your own creditworthiness, and market demand. For retirees, the big impact of higher interest rates is, well, higher borrowing costs. It makes tapping into home equity less attractive, more expensive. This can really mess with financial planning, reduce disposable income, limit access to affordable credit for emergencies or repairs.
And we've definitely seen rates go up. How does this affect retirees who might already have a mortgage or are thinking about one?
Yeah, recent research highlighted by Consumers.App shows rising mortgage rates increase debt servicing costs. This can lead to reduced household spending, especially for retirees often on fixed incomes. Studies show those with adjustable rate mortgages might see an even bigger drop in spending power because of those fluctuating rates and unpredictable payment hikes. Higher payments mean tough choices, cutting back elsewhere.
Not exactly the stress-free retirement dream. Focusing back on ELO-loose, what are the potential benefits versus the risks for retirees in this higher rate world?
Consumers.App notes the main benefit is flexibility. Accessing equity for income supplements, unexpected medical bills without selling the home. But the risks, they're amplified when rates are high. Monthly payments can jump rapidly. And since many ELOs have variable rates, retirees could face big payment shocks they just can't absorb on a fixed income. That unpredictability can seriously jeopardize long-term financial security.
Wow, sounds like retirees need to tread very carefully with ELOs now. Are there general strategies experts recommend for retirees managing money in these conditions?
Recent academic work referenced by Consumers.App suggests retirees need to carefully look at their tolerance for risk, both liquidity risk accessing cash and investment risk. Different risk appetites lead to different strategies for withdrawing savings, like deciding between guaranteed income like annuities versus more flexible drawdown plans. The key takeaway seems to be review and maybe adjust your financial plan because of rising rates. Ensure your retirement income is sustainable.
It really underscores that retirement planning isn't a set-it-and-forget-it thing, is it? What about loan length? How does extending the repayment period, like on a mortgage, affect retirees?
Extending the amortization period, as Consumers.App explains. Yes, it means lower monthly payments. That can seem easier initially, maybe helps you qualify, but the big trade-off, you end up paying way more interest over the loan's life. So while it gives short-term relief monthly, the total long-term cost burden gets much bigger. That can impact overall security down the road.
A classic case of short-term gain, potential long-term pain. Okay, another headline from Consumers.App, this one via Investopedia, offers a bit of a positive twist. Worried about your job? Here's how today's high interest rates can be your ally. How can that be?
Yeah, it's an interesting shift in perspective. Consumers.App highlights that high rates can actually benefit people building a cash emergency fund because savings accounts, CDs, other low-risk stuff tend to offer higher returns when rates are up. So the money you stash away in, say, a high-yield savings account, can grow faster, giving you a bigger safety net for job loss or other surprises.
That's a good reminder. High rates aren't all bad news. Now, we hear interest all the time. Can you quickly break down simple versus compound interest? Why is compound so powerful?
Absolutely. Simple interest. Calculated just on the initial amount, the principal, compound interest, calculated on the principal plus any interest already earned. Consumers.App emphasizes this interest-on-interest effect. It can dramatically speed up savings growth over time. It makes compound interest a really powerful tool for building wealth, especially when rates are decent and you have time.
That compounding effect really adds up.
Yeah.
So practical steps. What can people do now to leverage higher rates for their safety net?
Consumers.App recommends a few key things. Prioritize moving savings to high-yield accounts offering better rates. That's number one. Set up automatic, regular contributions to savings. Make it consistent. Look for ways to trim non-essential spending to free up more cash for saving. And maybe diversify short-term savings into things like short-term CDs to lock in higher rates for a bit.
Solid, actionable advice. Okay, let's move to a topic close to many hearts and sometimes wallets, our pets. Consumers.App featured a Reading Eagle piece. Buy pet health insurance or start pet care savings account. Ask the vet. What's the core choice pet owners are facing here?
Yeah, Consumers.App lays out the fundamental trade-off pretty clearly. Pet health insurance is about transferring financial risk. For unexpected, maybe huge vet bills, you pay a premium, the policy covers certain things. A dedicated pet care savings account, on the other hand, is self-funded. You proactively save money just for pet health care. Insurance protects against major shocks, but has exclusions, limits. Savings offers flexibility, but might not be enough for a big emergency if you haven't saved a lot yet.
The classic insurance versus self-insuring dilemma, but for Fido or Fluffy. It seems like more people are choosing pet insurance now, though. Why the boom?
The market has definitely grown substantially, as Consumers.App points out. Several drivers here. Rising vet costs, for one. Pet owners have higher expectations now for care. Advanced treatments are available. Plus, more people own pets, and there's that growing feeling that pets are family members, so owners invest more in their health.
They certainly are family for so many. Now, for those thinking about insurance, anything crucial to look out for in the policies before signing?
Oh, definitely. Consumers.App strongly advises consumers. Read the fine print. Carefully review the terms. Pay close attention to exclusions. What conditions aren't covered? What are the payout limits? Are pre-existing conditions excluded? They even suggest asking the insurer to review your pet's medical history beforehand. Get clarity on coverage. Groups like the North American Pet Health Insurance Association stress transparency so owners don't get nasty surprises at claim time.
Due diligence is key, it sounds like. Okay, let's shift focus one last time to another long-term planning piece, annuities. Consumers.App highlighted an AOL article. Does it make sense to delay annuity payouts until your 80s? What kind of annuity is this talking about?
This usually refers to a longevity annuity, also called a deferred income annuity, or sometimes a QLAC, qualifying longevity annuity contract. Consumers.App explains these are designed to provide guaranteed income starting much later in life, like late 70s, 80s. You buy it years earlier. It's basically insurance against outliving your other savings. Payouts only start if you live to that specified age.
So, planning for a potentially very long retirement, how does delaying payouts to your 80s affect the amount you get? And what are the main downsides?
Generally, yeah, the longer you delay the start, the larger the periodic payments will be once they begin. Consumers.App notes this. It's because the insurance company expects to make fewer total payments, statistically. But the primary risk, if you don't live to the payout age, you might get nothing back. You could lose the premium paid. Unless, of course, your contract has a specific rider or refund option built in. That's important to check.
Definitely a significant factor to weigh. Are these longevity annuities new, or do they have a history?
The basic idea of pooling longevity risk, it's actually centuries old, as Consumers.App points out. Early forms like tontines go back to the 17th century. Tontines worked a bit differently, but the core idea, sharing the risk of outliving assets, evolved into modern annuities. Research suggests while some tontines might offer similar benefits, modern longevity annuities give more predictable payouts, a more stable way to manage that uncertainty.
Interesting how these financial tools evolve. Who might benefit most from considering a longevity annuity?
According to Consumers.App, maybe individuals with higher than average life expectancy, those in good health, maybe with family history of longevity. It's also key to look at your other retirement income sources. These annuities aren't liquid until payout, so they're usually best for people with enough other assets to cover expenses in early retirement. And there are regulatory things too, like limits on QLACs and retirement plans. Lots to consider.
So, a specific tool for specific circumstances. Not for everyone. Finally, let's touch on another huge decision for retirees. Buying a home. Consumers.App highlighted an AOL article. Does buying a home in retirement make sense? What are the main financial factors retirees need to weigh up?
Right. Consumers.App outlines the key pros and cons. On the plus side, potential stability, building equity, maybe appreciation, but big risks too. Tying up a lot of liquid assets, exposure to market swings, ongoing costs like maintenance, repairs, insurance, taxes. Those don't go away. Retirees really need to weigh this against other uses for their money. Homeownership can be less liquid, more costly day-to-day than other assets.
And what role does financial literacy play in making this kind of big decision in retirement?
Interestingly, Consumers.App referenced a 2022 survey from Japan. It indicated that while higher financial literacy means more knowledge, That knowledge doesn't always directly translate into, say, more investment activity or different planning choices. It suggests that just understanding the numbers might not be the only thing driving a retiree's decision. Personal circumstances, preferences play a huge role too.
That's a really good reminder. Financial decisions aren't just about spreadsheets, are they? Well, we've certainly covered a lot of ground today on the deep dive. From credit score details and private credit's rise to all these financial considerations for retirees. It's clear the consumer finance world is constantly shifting.
Absolutely. And we've seen how interconnected it all is, haven't we? From everyday card habits impacting long-term health to global trends influencing huge life choices like buying a home late in life, staying informed, thinking critically, it's more important than ever.
Thanks so much for joining us on this deep dive into the latest from Consumers.App. Now, considering everything we've unpacked today, what's maybe one aspect of your own financial life that you might look at a little differently now or perhaps want to explore further?
It's a constantly evolving world. Taking a moment to reflect on your own situation, especially with these broader trends in mind, it's always worthwhile.
Indeed it is. If you found this exploration helpful, maybe it will pop the book. Be sure to subscribe to the deep dive. We'll bring you more insightful analyses of the information that matters.